Hello, everyone. Welcome back to another episode of Signal or Noise. Charlie Bilello here, and with me, as always, Peter Mallouk. Peter's is episode 72 for everyone watching. If you're watching this on YouTube, hit that subscribe button. We're also available on Apple and Spotify. Today, Peter, just one topic. What is gold? We're going to try to answer that question for investors. We get a lot of questions around gold, getting way more questions than usual over the past few months. Why is that? Well, the questions really correlate to performance, Peter. And as most people watching this will know, gold had a phenomenal year in 2025. It was up 64%, best year since 1979. And then in the first few months of this year, it really went parabolic, strongest one-year return that we've seen since 1979, 1980 period. The last time gold had that enormous run up, it was actually up 82% year over year as of the end of February before pulling back. So that explains why we're getting all of these questions around gold. And Peter, when you hear people talk about gold in the financial media, it's almost always just simply them predicting where gold is going to be a year from now or a few years from now. They're always happy to throw out a price target. Is it going to be 5,000? Is it going to be 10,000? Is it going to be 15,000? People love the extreme price targets because gold really trades on a narrative more than anything else. But that's not what you and I are going to do today. Today, we're going to really break down the historical performance and historical movements of gold, really a data-driven analysis of trying to answer this question: what exactly is gold? Is it a currency? Is it a commodity? Is it an inflation hedge? Is it a safe haven? A lot of different people have this debate about what exactly it is. We're going to break down each one of these categories today. But before we get into it, Peter, how do you view gold in terms of where it fits into these various categories?
Well, I think what's so confusing for people is there's actually truth to all four of these. It does behave like a currency. It is a commodity. It is somewhat tied to inflation, especially over the very long run. And historically, it has been a safe haven in certain instances. So it's got all of these narratives take hold for different reasons, whether there's wars or very high inflation or if we're in a speculative environment. So you see these kind of trade the lead in terms of what narrative is driving things the most, or why gold isn't moving at all. For people forget that that's what happens a lot of the time. Gold does nothing. It depends what horse is in the lead here.
For sure. Okay, let's get into the data. Start out with the currency question here. Is gold a currency? And what we're talking about here really is in relation for U.S. investors in relation to the U.S. dollar. So you hear a lot, if dollar's going down, that should be good for gold. If the dollar's going up, that should be bad for gold. There is some truth to that, Peter. We see a negative correlation here, negative 0.38. That's an R squared of 14%. And for the layperson, that simply means that 14% of gold's movement can be explained by changes in the dollar. So not anywhere near one-to-one if we're talking about gold and the dollar, which I think would surprise a lot of people.
Yeah, I mean, I think especially over the short run, I think this is the part that's hard to grasp. It might eventually price in the purchasing power of the dollar, but it tends to do this when it feels like it. We have very long periods of time where things don't match up. But I mean, generally, it is true that an ounce of gold 2,000 years ago, when Jesus was walking around, bought you a good outfit, and today it buys you a good suit too. And same with 100 years ago. So there is this very, very long-term correlation to being a store of value, which we would compare relative to the dollar, but it doesn't hold year to year.
Sure. And I would say it's just not the same thing as the euro or the yen or things like that. Because if we look at the dollar index starting in 1975 here, and everything we're going to talk about is starting in 1975, there's a reason for that. Before that, it was actually illegal in the US to own gold. So we're starting our analysis in 1975. But if you look at the dollar index, Peter, over this period of time, you can see it's gone nowhere essentially over this period of time. And gold is 25 times higher. So clearly it's not dependent on the dollar index or the dollar losing relative to other currencies. We know that gold is a store of value over time, which simply means it holds its own relative to inflation, but it doesn't require, let's say, a collapse in the dollar, which a lot of people talk about, for it to actually go up over time. So let's move on to gold as a commodity. It is a commodity. We know that, Peter, but it doesn't behave like many other commodities like crude oil or wheat or corn. It behaves very different, actually. And if you look at the overall R squared and correlation here, you could see it tends to move in the same direction, but not nearly all the time. 0.29 our correlation here. This is a rolling 36 months. You could see most of the time moving in the same direction, but only 8% of gold's changes can be explained by changes in the overall commodity index. And there's a good reason for this. Gold, very different. Other commodities are really based on supply and demand. They're influenced by how the economy is doing. Gold, much less so. And so what we see here is in periods where we have economic weakness, we tend to see a big dispersion in terms of what gold's doing and what the average commodity is doing. I'm showing you 2008 here as an example. Gold up 5% that year, and the CRB commodity index down 36%.
And makes sense, right? Because in periods of pullbacks, periods of recessions, people are buying less commodity, buy less stuff, whether it's coffee or corn or whatever. But they're also nervous, and nervous people tend to shift over to gold. And see, there's both of these things happening at the same time. So it is interesting. Gold's obviously commodity; it belongs to the commodity index, but it doesn't behave the same way for a lot of reasons.
For sure. Let's go to gold as an inflation hedge. And if I had to pick one of these, Peter, in terms of what the narrative for most people is in terms of buying gold, this would have to be number one. You always hear this.
Especially right now, right? This is the strongest narrative we have over the last 18 months.
For sure. And this is really relevant today because inflation has been moving up. It's been expected to continue to move up over the next few months. And we have break even inflation rates. So these are market implied inflation rates at their highest levels since 2022 at 2.7%. What that basically means is the market is saying inflation in the US is going to average 2.7% over the next 5 years. And if you look at the last 20 years or so, it's rarely been higher than this. So a lot of people would say, I'm going to go out and buy gold because I think inflation is going up. And there is some truth to that. Over time, gold has outpaced inflation. If we go back to 1975 again, you could see the ratio has moved up over time, hitting an all-time high in February. But you can see by this chart here, Peter, that it's certainly not a linear advance, nothing close to it. And if anyone would say, because inflation is up 10% next year or 5% next year, gold is going to do this or that, that's really impossible in looking at this chart.
Yeah, I think that while this narrative does hold some water, there's a lot of other things that impact the price of gold. So if we look at what's happening now, you have a lot of countries, sovereign wealth funds that they don't want to loan money to the United States. They don't want to invest. They don't want to support the United States. You see them shifting to gold too, because of all the tension all over the world and all of the wars that we've kicked Russia out of SWIFT, basically blocking them from access to transacting in the dollar since the war started with Ukraine, making other countries say, hey, wait a second, we can get kicked out of this system at any given moment, also creating more demand for gold. So there's always these other things happening at the same time, good or bad, that can influence the price.
For sure. And I think it's an important history lesson here for Peter, for people to understand that gold actually went 45 years, it sounds crazy, but 45 years without hitting an inflation adjusted high. So it peaked back in 1980. You can see the parabolic advance here on this chart. And then only last year do we exceed that inflation adjusted high. And then, of course, we went parabolic once again, hitting a new record. So if you believe, Peter, that gold should outpace inflation by, let's say, a few percent a year over time, then this ratio should move up over time. But if you believe it should simply keep pace with inflation, then this is going to be more of a mean reverting series where it comes back down to the historical average at some point of 1.2.
And history tells us that it finds its way back to the inflation return. And so when sentiment and artificial demand or other demands get pulled out of this, I think that's what we're going to see, and we'll see that sharp decline. Now, for that to happen, we need the narratives to change a little bit. $1 trillion every 5 months of deficit spending, continued U.S. isolation, and alienation of other countries. It might be a while before this plays out, but history tells us this ratio is coming down.
And I guess if you don't believe it's coming down, the question would be, Peter, what is the rational explanation for why gold should go up more than inflation over time, right? We have an explanation for equities because earnings grow more than inflation over time, and compounding that with dividends, that tends to lead to a real inflation adjusted premium. But what is the argument for gold? It's hard to really conceptualize that. It's in saying, why should it really outpace inflation over time?
One of the only ones I think out there that carries some weight right now is we a lot of countries used to put their money in dollars. Okay, they don't trust China. They're not sure the euro is even going to exist in 20 years. What other currency is there that you can buy a lot of and have a lot of confidence in? Used to be the dollar. Well, now there's countries that just don't like the United States. There's countries that are alienated from the United States. There's countries that aren't allowed to do business with the United States. And that then causes a shift over to gold, right? And so you have some reasonable explanation for what's happening now. The question is, does it persist?
That's right. And in terms of breaking down expectations here, Peter, I think this is pretty important because I would say expectations for gold right now are very high. Why are they very high? Because we've seen the highest returns for gold that we've seen since 1980, which was the last major peak in the asset class. So we're looking at returns here over the last 3 years, averaging 30+% per year. That is nowhere near the historical return for gold, which is a little bit above 6% per year. So, really, the question, Peter, in terms of inflation hedge, we know the last 3 years gold has done tremendously well. Most assets have done tremendously well. The question is gold an exceptional inflation hedge? Is it better than many other different asset classes? And does it have periods of time where it fails to be a good inflation hedge, like this period from 1981 to 2000, where it was actually cut in half when prices in the US doubled?
Yeah, I think to me, this is the warning chart for people that are hanging their hat on the inflation argument, that you've got this multi-decade period of real negative returns. This is something that could truly happen again when things start to right themselves. So I think people that are thinking about going all in on gold, this is the chart to pay attention to.
So it's certainly a possibility. We're not predicting that, of course, but if it happened in the past, of course, it could happen again. And I think the broader point is that there are other asset classes, not just gold, you can invest in that can protect you against inflation. If we look at this period of time since 1975, the S&P 500, 12.5% return nominally, REITs, 11.2%, investment grade bonds, corporate bonds in the US, 7.3% per year, and you have gold at 6.3%. So gold certainly outpacing inflation, which has averaged 3.7% per year over that period of time. But if you compare that to investment grade bonds or REITs or the S&P 500, really no comparison.
Yeah, I mean, I think the surprising thing for most people is you get higher volatility with gold and a lower return than bonds, right? The asset class is more volatile than other asset classes with a lower return, not just than stocks, not just than real estate, but then bonds. And I think that to me is, I mean, we don't, obviously the upside volatility, everyone loves it. And that's why everyone's asking about gold now. Volatility goes both ways. Very rarely do you see a low return with high volatility. If you're looking for that, gold is the right place to be.
Yeah, and this chart illustrates that point here. Gold since 1975, 19% annualized volatility, REITs at 17%, S&P at 15%, and bonds at 7%. And the bonds one is important, Peter, because I don't think anyone would be talking about bonds being an inflation hedge. But if you actually look at, let's say, rolling 5 or 10-year periods for bonds versus gold, and which has outpaced inflation more of the time since 1975, it's actually investment grade bonds, which is kind of crazy given the narrative around gold. Let's go to gold as a safe haven here. I'd say this is probably number 2, Peter, in terms of ranking them. A lot of people predicting the end of the world. There's always people predicting that, of course, but they're saying if I just buy some gold, I'll be in good shape if that were to happen. And what people will often point to is that gold doesn't move like the stock market. And that's absolutely true. We see the overall correlation is essentially zero between the S&P 500 and gold. But zero, Peter, doesn't mean that they don't move together. It just means that there's really no predictive power to say if the S&P does this, gold will do that. There are many periods of time where S&P is up and gold is up. We've seen that in the past few years. There's other periods where they're both down. So really the question is gold reliable when the S&P 500 is down? And I think this chart here might surprise a lot of people. If we rank the worst S&P 500 monthly returns over since 1975, the worst 20 monthly returns, gold was up in 11 of those months. So not terrible, but it's only a little bit better than a coin flip that it's going to be positive. And I went back and looked at just any random month in terms of if the S&P 500 is down, it's only slightly above 50%. Does that stat surprise you, Peter?
It doesn't surprise me because in times of panic, people try to raise capital. And so if gold is negative, but less negative than other asset classes, that becomes a place where people go to raise.
Yep, for sure. And so if you're looking for a safe haven in your portfolio, it's more likely that you're going to get that from bonds, and especially things like treasury bills that only go up during periods of crisis. Gold has a better chance than other risky assets, but it's certainly not anywhere near a guarantee. And during extreme panics, Peter, and we saw this in 2008, and I think it shocked a lot of people, it is a source of liquidity at that point. People are selling their gold and putting it into treasury bills. That's really the only safe haven asset at the extreme levels of panic. So let's end here saying what gold is. This is what, when people ask me, Charlie, what do you think gold? I say it's an enigma. It's simply an enigma because it's part all of these things. It's part currency, it's part commodity, it's part inflation hedge, and it's part safe haven. But it's none of these things reliably so. So if you want to bet against the U.S. dollar, you're better off just shorting the dollar. If you want to bet on commodities rising or falling, you're better off looking for broad commodity exposure. If you're looking for a pure inflation hedge, Peter, it seems like you would get that better in something like a TIPS instrument or something more closely tied to the actual inflation rate than something like gold, which we've seen 20-year period where it's declined and prices have doubled. And if you're looking for a real safe haven, gold may act like that, but you're more likely to get it in something like treasury bills. Have I convinced you yet that this is an enigma?
Well, it is an enigma. I got a question for you, Charlie. So if I told you had to put all your money in one asset class and meet me 1,000 years from now, what asset class would you choose?
Well, I'm an optimist, Peter. So I would say like a global portfolio of stocks and say that human ingenuity. But if you're saying like pricing in tail risks of nuclear war and everything, wiping out civilization,
I'm just saying we're getting on a spaceship and we're getting off, and then you're going to go pull your money out of one asset class. What would it be?
In that scenario, I guess you could say, since gold has been around for the longest, and we know it persisted through other calamities, and we don't necessarily know that will be true with things like stocks or bonds, then you would have to say gold. That is not the time horizon for most investors, eternity, but is that how you're looking at it too?
Yeah, so I look at it, I agree completely. It's part currency, part commodity, part inflation hedge, part safe haven. And over a multi-decade period, 20, 30, 50, 80 years, people are better off hedging against these things in other ways. Like as Warren Buffett said, gold just sits there, it does nothing for you. Real estate produces income, dividends come from stocks, yield comes from bonds, even cash pays you something. Gold, you're just counting on somebody to pay you more for it. Yes, I realize it has some utility, but for the most part, that's what you're looking for. So as an investment, I think it's lousy. Like as your chart showed, you're getting the highest volatility with the lowest return of all of the major asset classes. No, thank you. But what I do think holds true is the reality is 10,000 years ago, gold was money. 1,000 years ago, gold was money. 150 years ago, gold was money. And 1,000 years from now, gold will probably be money. So if you're putting me on a spaceship and I had to put everything into one thing and show up 1,000 years from now, it certainly wouldn't be any cryptocurrency. And it probably wouldn't even be stocks or bonds or the dollar or any other currency. It'd be gold. But we don't have 1,000 years, right? And so if you're planning on 100 years or less, every other thing that you're looking for, whether it's an inflation hedge or a currency hedge or a safe haven, there's other ways to do it that have less negative tax consequences. Gold is taxed at a higher rate, have less volatility. Gold has the most volatility of any major asset class and a better expected return. Gold has the lowest expected return of the major asset classes.
For sure. Now, all that said, Peter, we still get the question, well, what if I just put 5% of my portfolio in gold? I treat it as insurance. And so I ran the numbers there. And because gold has a very low correlation, despite the fact that it has higher volatility and that lower return we talked about, it really wouldn't have hurt you over this period of time to have 5% of your portfolio in gold, taking it from the stock portion of your portfolio. You would have actually had the same exact return, almost the same exact volatility over this really, really long period of time. Now, if we did the same analysis 10 years ago, it would have detracted, right? So it's getting the benefit of that parabolic advance over the last few years. So what do you say to someone who says, Peter, I hear everything you're saying about gold, but I still want 5% just in case this bad outcome happens and gold is the only thing that survives it?
So the first thing, you're not starting at zero, right? So if you own stocks, you probably own, when you own indexes, you own companies affiliated with the price of gold, whether it's gold mining companies or companies that have gold on their balance sheet or that make money on the trading of gold and so on. So there is some exposure there. But if you want to add another 5%, my attitude about that is, go ahead. Like, this is not a hill to die on. We're not talking about something crazy speculative or something with a negative expected rate of return. And so I view it as, look, if you've got strong conviction that you want to have even more exposure, as your chart shows, it probably plays out over the very long run in a similar fashion.
Yeah. But I guess the question is, for an investor, let's say in their 20s, 30s, 40s, they have a 30 plus year time horizon to believe that gold is going to be the best performing asset class, you would have to be making very negative assumptions about the economy, about corporate profits. And that's really, you have to have a pessimistic outlook to really put a substantial portion of your portfolio in gold, I would say.
I don't own an ounce of gold that isn't incidentally owned through some sort of stock market index. And I would never recommend it as an investment, because we're not going to get the income. We're going to pay higher taxes. We're going to get more volatility. We're probably going to get a lower expected return. Having said all of that, if it brings some comfort, it's slightly uncorrelated and close enough to a return on bonds that taking a small portion and moving it there, if you have a lot of conviction, totally fine.
Yeah. So if it helps you, what you're saying essentially, if it helps you stick with your overall portfolio, helps you sleep at night because you have that position, then maybe it's worthwhile, even if it detracts a little bit from performance over time. Great discussion, Peter. Really enjoyed that. If anyone's looking at their portfolio, thinking what to do for the rest of the year, thinking about how gold should fit into all this, reach out to us today at Creative Planning. Go to creativeplanning.com/Charlie for a free wealth path analysis. At Creative Planning, we're in all 50 states, so we likely have a location right near you, over $700 billion in assets under management and advisement, and we're here to help. So reach out to us today at creativeplanning.com/Charlie. I'll have a link in the show notes. Great show today, Peter. Thanks, everyone, for joining us for this episode of Signal or Noise. If you're watching this on YouTube, once again, hit that subscribe button. We're also on Apple and Spotify. And Peter and I will see you next time on Signal or Noise.